Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. Now, the key feature here, much as in other grain markets, had been the monthly key reversal up in July. The reason for the more recent move up goes back to the drop in early September. This fall was eventually halted at the time by the odd combination of the rising short-medium moving average, currently at 799, and the lower tine of the late March to July bullish Andrews pitchfork, currently at 828. If that wasn't enough, just below was also, at the time, the rising medium moving average, currently 763. This all started the latest move up, and in the process creating a small reverse head and shoulders pattern over September. The subsequent move up petered out after prices ran into some congestion from 2013 between 883 and 914, and finishing with a daily bearish harami 3 weeks ago, followed by a bearish engulfing pattern only just at the start of 2 weeks ago. Ultimately, prices failed to reach up to the middle tine, currently at 953 of the same late March to July bullish Andrews pitchfork. Whilst all this was going on, I had drawn a fresh bullish shift pitchfork for the early July to early September action. Now, the market moved up over the middle tine of this bullish shift pitchfork, currently at 876, but also petered out upon approach to the upper tine, currently at 945, as this was synonymous with the middle tine of the original bullish Andrews pitchfork. Anyway, prices peaked 3 weeks ago and fell away thereafter. The next key event was last week, on the Wednesday, when we had the lower tine of the original bullish Andrews pitchfork broken. This move lower has been exploited and thus seemingly rendered the original bullish Andrews pitchfork no longer valid, and I will retire it after this commentary. However, the action did not stop there, as prices then tackled the combination of the lower tine, currently 807, of the more recent bullish shift pitchfork, as well as the rising short-medium moving average, currently at 799 even. This was penetrated but not really broken, and these attempts lower have sort of continued until today, with a seeming rejection yesterday for a small interim possible pipe bottom. And that saw today prices move back up over the lower tine. Now, this pitchfork, though breached, I will still leave on the daily chart after this commentary, as it's still being fought over. However, it would be not a surprise to me to see a further fall down to the old reverse head and shoulders neckline, currently at 743, from September, assuming, of course, that the rising medium moving average, currently 763, is dealt with in the meantime. The only thing that may be positive for the bulls out there is if prices are held by the lower tine and short-medium moving average combination. Then it will allow me the opportunity to draw a more recent mid-September till this past week bullish Andrews or bullish shift pitchfork. However, that discussion will happen at a later date, when the construction of this bullish pitchfork may or may not be secured. Minneapolis wheat. I have really admired this contract in the past. I still do admire this contract, as it was and is a great example of a series of brilliant technical actions. I've indeed repeated this same mantra now for months, literally months. Recently, we had started to see some fraying, considerable fraying in the long-term technical patterns that have been evident here. Have been evident since early April. This never meant that these long-term technical patterns were dead. No, it just meant what I said, that they were getting a bit frayed. The key and supremely important pattern here is the December 2020 to early April bullish Andrews pitchfork. This pattern has run this market higher so successfully, and it was and is, after a fashion, still valid here, though you would have to allow for some of the aberrations we've had seen over the summertime, and also more recently over late October and going into November. The bullish incentive initially took an even stronger turn, piercing and closing over the upper time, currently at 1076, making a concentrated move higher. But finding the more acute bullish angle to be too much, and then decided to travel sideways for a bit before this week coming back down to rest, it seems, on the combination of the middle time, currently at 1002, and the short medium moving average, currently 1003. The cause of the turn back down was something I had pointed out 7 weeks ago and repeated ever since. It is the significant resistances overhead, specifically the July 2012 high at 1034, the May 2011 high at 1055, and the May 2008 high at 1083. The market tried most of these resistances, and the initial result had been a stalemate of sorts, neither going higher nor heading lower, before finally trying lower, but also getting stopped in this endeavor. Further below, we also have an interesting support congestion zone between 986 and 974. This congestion area is made up of the 50% absolute Fibonacci line at 974, the November 2012 high at 977, and the September 2012 high at 986. It will be interesting to see what would happen should we really start moving lower. However, I'll finish once again with my last words from 7 weeks ago and repeated ever since, and I quote, "All things come to an end. And perhaps, just perhaps, these recent actions are the first inklings that the original December 2020 to early April 2021 bullish Andrews pitchfork is heading that way." End of quote. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.